what I want to do is I want to go over an example where we are doing straight line depreciation. And this is one of the more easier depreciation methods to understand. As a result, students tend to like straight line depreciation a lot, as well as businesses. It's very common for businesses to do it straight line. So the first thing you need to know is what the purchase price of the piece of equipment is. So it's not only going to be the price of the equipment, but it's also going to be all the costs to get that piece of equipment delivered. It's going to be the cost of taxes, if you have to pay taxes on that piece of equipment. Everything from a hitch on the bottom of the truck. So you spend $30,000 for the truck, $500 for the hitch. The total purchase price would be the price of the truck plus the price of the hitch, $30,500, for example. So in this particular case, what we're going to assume is we've got a ski lift piece, ski lift. Say we spend $40,000 for the ski lift. We spend another $25,000 having the ski lift delivered and installed on our property. So if it's $40,000 plus $25,000, that's $65,000 would be the cost of that ski lift. Then the next thing you do is you calculate or you remove from that number the salvage value. And I'm just going to put salvage value as being $5,000. What salvage value is, it's the value that you can sell it for at a salvage yard, either for the weight of the metal, or in the case of a vehicle, maybe you'll be able to sell it on Craigslist at some time in the future for a certain dollar amount. So it's a guess. Salvage value can be zero too. You can assume there will be no salvage value in that particular case. Anyway, so $65,000 is the amount, the cost minus the salvage value. That gives us $60,000, and this is the amount to depreciate over the life of the asset. Once you hit $60,000 in accumulated depreciation, you stop depreciating the asset. So even if you have it longer than the useful life, as soon as you hit $60,000, the amount to depreciate, you stop. Then what you do is you divide the $60,000 divided by the useful life. In an academic setting, I'm going to have to tell you what that is. So we're just going to assume that the ski lift will last 10 years. Therefore, depreciation per year is $6,000 per year. So every year, it's a flat $6,000. It doesn't vary. It's straight $6,000 per year, hence straight line depreciation. So the journal entry for this transaction, assuming you bought usually you install ski lifts in the summer. So in, let's say, June 30th, or actually let's put July 1st, 2016, you bought the ski lift for $40,000, paid another $25,000 to have it installed. Salvage value of $5,000, over a 10-year useful life. The journal entry when you bought the piece of equipment would be a debit to equipment for the purchase price, which is $65,000, and a credit to $65,000 for however you paid for it, perhaps cash. Okay, so that's the journal entry in the summertime when you went out and you purchased the ski lift equipment. If you had a fiscal year of 12/31, when 12/31 rolls around, you would do your adjusting journal entries if you hadn't done your adjusting journal entries during the month. So 12/31 rolls around, and if you're using straight line depreciation, you've had that asset for 6 months. So from July 1st through 12/31 is 6 months. So 6 months, or 1/2 of $6,000, is $3,000. So the journal entry on 12/31/2016 would be a debit to depreciation expense for 1/2 of 1 year, which is $3,000, and a credit to accumulated depreciation equipment, or lift equipment, whatever the name of your asset is. And it's very important that you put the name of the asset along with the accumulated depreciation so you know where on the balance sheet that's going to belong. So you would have equipment, and then directly underneath that you would have less accumulated depreciation equipment, $3,000. So this would be your first journal entry that you would make in at the end of the first year. You would take 1/2 of a year. Now, the journal entry on 12/31/2017, after you've had the equipment for a full another year, the piece of equipment is 1.5 years old, it would be a debit to depreciation expense. Debit to depreciation expense for $6,000 this time, because you would have had it for a full year at that point in time. Debit depreciation expense $6,000, and you would credit accumulated depreciation equipment for the $6,000. So that's the journal entries. Those are the journal entries that would be made during the first year and a half of owning the piece of equipment. Now, let's assume that in June of 2017, you sell the piece of equipment. Another ski resort buys your piece of equipment, and at June 30th, you sell that piece of equipment for, let's say, $30,000. Okay, so $30,000. You want to replace chair 8 for another new chair 8, and you sell it for $30,000. Well, the first thing that you need to do is you need to get caught up on the depreciation. So we've been caught up to 12/31/17. So now what we need to do is we need to get caught up to 6/30/18, because if you sold it on 6/30 or July 1st for $30,000, you need to get caught up on that depreciation. So on 6/30/18, the first thing that you would do is debit depreciation expense for another 6 months worth of depreciation, which would be $3,000. It's $6,000 per year. Half a year would be $3,000. And you're going to credit accumulated depreciation equipment for the $3,000. So that's the first thing, and that gets you caught up with depreciation, because up to that time, you only had recorded the depreciation up to 12/31/17. So 6/30/18, you get caught up on the depreciation. Then once you've done that, then you can get rid of the asset. And so I said an example on 6/30/18, you sold the chairlift for $30,000. So if you sold something for $30,000, assuming you received cash for $30,000, we would debit cash for $30,000. We would credit equipment for what is sitting in the equipment account, which is $65,000, because we have an equipment account of $65,000 here that's sitting there. We've got to credit that because we don't have that piece of equipment anymore. You would get rid of the accumulated depreciation equipment, whatever is sitting in that account. And the amount that is sitting in that accumulated depreciation account is a total of $12,000. It's $3,000 from the first 6 months, $6,000 for the next 12 months, and then another $3,000 for the time period of 2018. So we've got $12,000 sitting in the accumulated depreciation account. Obviously, those are all credit balances of $12,000. So you're going to debit accumulated depreciation for $12,000, eliminating that account. We now then would have $42,000 worth of debits, $65,000 worth of credits. So therefore, you need another. What do you need? You need another $23,000 worth of debits to make this work. And with $23,000 worth of debits, the account that we are going to debit is a loss on sale of equipment. If it was a credit that was a plug, and this is what we call a plug when we are calculating what the $23,000 is, that's a plug. If it ends up that we needed to make a credit instead of a debit as the plug, then it would be a gain on sale of equipment. But in this particular case, you have a loss on sale of equipment, $23,000, and this would be the journal entry for the disposal of the equipment. So anyway, hopefully that helps. If you have any questions, we can talk about it in class. Follow my other lecture for units of activity example.